Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Darren Sissons is on the show today. He's partner and portfolio manager at Campbell, Lee & Ross Investment Management, and we'll be taking your questions on global and technology stocks. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Darren joins us in studio. It's good to have you in.
Good to see you again.
There's a lot to talk about.
Yeah.
It feels like that every day, but today, of course, all eyes are on Nvidia, which is reporting earnings after the bell. Since I know you're very much into tech stocks as well, what are you expecting to see? Like analysts, I'm reading a lot of analysts expecting another blowout earnings report. Do you think that's what we're going to see?
Look, I think Jensen Huang has become the new John Chambers, which is, for those who don't know that reference, it was he was the CEO of Cisco during the dot-com era, and he was famous for underguiding. And what would happen is I think he beat something consecutively for like 10 years in a row. And all that's really a function of just not providing enough guidance, appropriate guidance, and allowing enough wiggle room so that they can keep beating the numbers. And then what would happen is everyone goes, oh, great, it's fantastic numbers, because they would always beat. And so I think the same thing here is. I think the big issue is going to be for Nvidia when it actually does miss, because they are soft padding guidance. So the likelihood of them beating is, I would say, better than average.
But that's a tactic, you're saying?
Yeah, it's a tactic. It's what CEOs do. It's how they move the stock, right?
Interesting.
Yeah. So like I may be wrong. We'll check in on that.
We'll have to wait and see. Yeah, but that's what you're thinking.
It's a game. Don't hate the player, hate the game kind of story.
Interesting. In terms of tech as a whole, I mean, obviously, such a run in 2025. Is that still where you would advise investors to go, or where do you think investors should be looking as we head further into 2026? Yeah,
so we tend to run more of a diversified portfolio. We obviously have some tech assets. I think one of the interesting developments in tech is you've seen a wholesale sale of enterprise software and other segments of software, and that is leading to, I would say in some cases, some quite ridiculous valuations for some stocks. And then on the AI side, the fundamental belief is just because you can build software, that's just going to create a company and a new opportunity. Well, I think that in many ways is a build it, they will come. So to build a company, a successful company, and to scale it, you obviously have to be in a situation where you can build the code, but you actually have to communicate with clients, customers. You have to retain the business and grow it. So just because you can build software, it doesn't mean you can build a business. So I think there are going to be some opportunities in tech. I think med tech is an interesting area, considering the big sell-off last year. But I think really when you think about, we've got an election year, a midterm election year, you've got the president, he's going to not want to become a lame duck, so he's going to have to spend. And that's going to mean that growth is going to be positively influenced by that spend, as it was last year. So, Trump, like him or dislike him, he's a wealth catalyst and everyone's benefiting. So expect a continuation of that for growth, I would say, in some shape or form.
Interesting. Okay, we're going to take a quick break right now, but we will be back with Darren Sissons of Campbell, Lee & Ross Investment Management, taking your questions on global and technology stocks right after this. Stay with us. Welcome back to Market Call. Darren Sissons joining us on the show today to answer your questions. We're going to start with an email question from Colin, and this email reads, NA, which is National Bank, has you think about maybe holding this company, I guess? It sounds as though Colin already has it. Thoughts on the company?
Yeah, so we own it. It's part of our portfolio. It's done great. Good numbers today. And obviously they, perhaps viewers don't know, but they provide the custodial services for for a big swath of the Canadian independents and some of the very larger companies. So good offering. I think it's business is going to continue to do well in this environment. Perhaps the only caveat I would say, and this is more of a sector general, if the USMCA trade agreement gets ripped up, then we're probably going to see some economic pain here in Canada a little bit. Perhaps interest rates might fall, which would be somewhat negative for the banks. But they had such a great run. when companies have a great run, you might want to take a little bit of profits or just look at other areas in the portfolio to allocate. So you probably don't want to and push money into a name that's just gapped up like it has. But good company, and we will continue to own it moving forward for clients.
Interesting. I think that's the case for a lot of companies, right? As we look ahead to these renegotiations this summer, it's like a lot could change in the meantime.
Yeah, I think that's true.
Yeah. Okay, we're going to go to the phone lines now. Chris is calling in from Delta, BC with a question. Hi, Chris.
Oh, hello, Lindsay and Darren. Thank you for taking the call as always. Darren, I'd like to ask you about Apollo and the private equity industry in general, with all the things going on in the world, and I'd be curious to hear your thoughts for a long-term investment. I'll hang up and listen. Thank you so much.
Okay, thanks for your question.
Yeah. So in a prior life, I actually worked private equity, venture capital as well. And I used to make funding commitments to fund companies. So I'm just from that experience alone, I'm fairly familiar with most of the large, big private capital shops. Haven't actually had exposure directly to Apollo itself, but I understand the business. It effectively started out as a distressed business where they would buy companies when they were distressed. And, obviously they had the issue with regards to Leon Black moving on. I think that's correct. But I think that if you think about looking to a company that specializes in a distressed segment of the markets, and it's not just what they do, but that's where their DNA comes from. If the president spends this year, as he did last year with the 7% deficit plus the 13% increase in defence spending, you're kind of looking at a situation where how much distress is going to show up. And I know there are headline risk around private capital, private credit, but really that, where's that going to show up? So at this point, I think it's a decent, well-run franchise. If you look in the US, I had much closer dealings myself with KKR, and I prefer that franchise myself. But here in Canada, you've got Brookfield. So I think the category is interesting. And as a general rule, just buy companies where they're slightly on sale, and that's the takeaway. So yeah, it's a good company.
Okay. John now calling in from Milford, Ontario with a question. Hi, John. What's your question?
Good day. I would like your guest thoughts on making Nova Scotia going forward. I think the earnings are coming out soon. I'd like to add to my portfolio. Thank you very much. Bye.
Okay. Thank you.
Yeah, so similar comments to what I've said twice already. You probably don't want to be pushing capital into something that's actually moving quite significantly. And so look at the chart.
Yeah.
And so from a practical point of view, okay, if you're going to push money in, then all you're going to do is increase your exposure. So think about weights. But the time to buy Scotia was when they had effectively the succession issue once Brian Porter left, and then you had the new CEO come in, and it was kind of dead money for a little bit. That was the time to push money into the company, and it's obviously worked quite well nicely. You can see that from the charts.
Yeah.
So you want to buy names when they're a little bit on sale, especially good quality franchises. But as a general rule, I think the Canadian banks are obviously very good franchises. They will have credit issues if we have a major USMCA issue. So perhaps you might want to look a little bit outside of Canada to decrease your exposure, particularly if you want to put more exposure into the banks. JP Morgan is a good company in the US, so perhaps think about it like that.
Okay. And now Elliot calling in from Hamilton with a question. Hi, Elliot. What's your question?
Good afternoon. I'm interested, please, in a global financial, and I've been looking at Santander SAN or Citigroup C. Would you recommend either or neither, and why? Thank you.
Okay, thanks for your question.
Yeah. So, I think off the top, I think that if you're looking for a global financial, I think Munich Re is probably a better company than both. If you look at the chart of that, that's actually a better company.
Which company, sorry?
It's called Munich Re. The ticker would be MUV2 or MURGF for the US unlisted ADR. But having said that, Banco Santander, I think if you look back at the history of, say, 2008, when risk management really mattered, Citi had none, Santander had some, for sure. So Santander's it's a bank headquartered in Spain, good quality franchise, very much a Scotiabank type equivalent over there, but more broader and more global and bigger. So just sticks to this knitting. The Citibank story is it's done quite well. Obviously, once the market started to recover, they split it up into a couple of pieces. So, look, it's going to be a too big to fail story. So, just on the risk management culture alone, I'd probably default to Santander based on the prior history.
Okay. We've got another question now, another phone question. Ray calling in from Pickering, Ontario. Hi, Ray.
Oh, hello. Good day. Firstly, Lindsay, you're doing a great job. Great addition to the Bloomberg Canada team there. Darren, I took a position in Cisco a couple of weeks back when it kind of got beat up after their earnings call, and I don't see anything wrong with this company. With the data center build-outs, everyone's going to be, well, most people I think are going to be looking for Cisco gear to build out these data centers. So I was just wondering if you're, what you think of my position, taking that position a couple of weeks back. Thank you.
Okay, thanks, Ray, for that.
Can we show that a little bit further back? Maybe show me 10 years. I think this is the point. So so I think. You kind of need to know some history here. So Cisco, and I mentioned John Chambers, and he ran Cisco, and he was the CEO that always underguided. So I think the story with Cisco is that it was one of the few of the big tech names from 2000 that didn't run, Intel being the other one. Oracle's run, Microsoft ran, Broadcom. So all the names that were the hot names then, although they became dead money, ultimately, if you look at the story for those names, they've actually done well, whereas Intel and Cisco have been the laggards. And I do think that Cisco is going to be a company that will benefit from the demand of data centers. But you've got, outside the US sphere of influence, you've got Huawei, you've got ZTE also have some equipment. So Cisco is not going to be the only game in town. And I think at these valuation levels, I'm kind of, okay, you made some money here, maybe it's just time to move on. It's not a name that we would buy because I just don't think it's got a sufficient, significant enough moat around it.
So you're saying maybe it's a sell if you already have it?
If you made some money, I'd probably sell it. You'd probably look at other opportunities.
Yeah. Okay. We're going to take another quick break right now. We'll be back, though, with Darren Sissons of Campbell, Lee, and Ross Investment Management, taking your questions on global and technology stocks right after this. Stay with us. Welcome back to Market Call. Darren Sissons is joining us on the show today, answering your questions. We've got a lot of questions coming in. We'll go to the phone line. Sam is calling in from Ottawa with a question. Hi, Sam.
Hi, good afternoon, guys. Thank you so much for taking my call. So my question regarding Brookfield Asset Management. Now, with the previous call regarding Blue Owl, like the private equity and whole fiasco, the scareness. The thing is, Brookfield Asset Management, if you look at infrastructure and renewable, they're running hot, all-time high. And that's 60% of Brookfield Asset Management revenue. And if I'm looking at their revenue from last quarters, the private equity did drop a little bit. So did real estate a little bit, but their loan went up. So I feel the Brookfield Asset Management is on a major discount. I own some, so recent decline with the Blue Owl, we double our position. And maybe we're crazy a bit, but that's okay. What's your opinion? Thank you so much for taking my call.
Okay, informed question.
Okay.
Thank you.
Yeah. So when you look at a private capital company, they're made through multiple agreements of long periods of time with completely different funds. And then they build a franchise off the collection of the funds. Now, some of those funds are going to come off, some of them are going to mature, you're going to raise new funds and things like that. And so the investments are either within within one fund, there's complexity to move them through funds, and then you have some public money. So, I would say, I don't think, it's very seldom that I actually see public analysts actually do analysis on the sector that I actually think is good. Because they haven't spent time in the trenches and having to decompose them very well. Right. And it's just a general criticism. So to look and say that something is undervalued at the moment based on a past track record, you've got to assume what's happening to the capital base, you've got to assume to the pipeline of projects, you've got to assume what's happening to the economic segment, and you've also got to think about the money's typically raised in 10 to 12 year blocks, five investment. So having said all that, I think Bruce Flatt was on the show earlier today, like different segment, and I think he made some pretty interesting comments. He's done very, very well with the company. We own it. I think it is a good franchise. But to think that these businesses are not going to be subject to some downdrafts if we see, a recession or things like that, is probably not the case. And just because something dips 10%, you've got to be a bit careful. So, quality franchise has a very, very good track record, but it's a very complicated beast. And just because you're going to look at the filings, you've got to look much, much deeper than that. See what they're actually doing. Look at the press releases and things like that if you really want to understand what's going on.
Okay.
So, so here, if you don't own it, maybe buy some. If you own a little bit more, maybe add a little bit more. But, these things are multi-year cycles. Right?
Okay, good to know. We're going to go back to the phone lines. Peter from London, Ontario, calling in with a question. Hi, Peter.
Hi, Lindsay. You're doing a great job.
Thank you.
Darren, I stand to be corrected, but it's my understanding that Irish company CRH Public Limited is top of the heap with reference to the building materials industry, yet the stock doesn't seem to reflect that position. Could I have your comments on the company and on its prospects, please? Thank you very much.
Okay.
Yeah. So I think it's an interesting company. So originally headquartered in the UK, there's also a listing originally headquartered in Ireland. There's a listing in the UK and also a listing in the US, if I remember correctly. I did look really closely at it, particularly during the Obama period. And I think the phrase that came to mind was shovel ready. Would the company benefit from shovel ready projects? And so by market, they have different end exposures. Like they have quite a lot of exposure, if memory still serves, into the asphalting and roadworks in the US. But they also buy companies like Windows and various things like that. Windows companies in Poland and various things like that. So they have good operations. So relatively diversified company, does sort of growth by acquisition, tends to grow the businesses. So it's been quite a good company over long periods of time. It does benefit from infrastructure. But just because the stock doesn't move, that's not necessarily a reason not to look at it. If the track record is good, the dividend is good, and the growth prospects make some sense, then you want to look at it. I like the company, but to me, the challenge is it doesn't really do anything completely different than other companies. Like if you look at, for example, an infrastructure company would be Skanska out of the Nordics. Great company. Some of these companies that add value is when they actually retain a portion of the assets, like the old SNC used to do with the 407 and things like that. So that's probably what I'm looking at. So look, CRH, when it goes on sale, you can probably buy it, but you're going to get a trade. It's not a long-term structural trade unless it does some more value-creating actions. So as a general, that would be my parameters to own it.
Okay, we're going to go back to the phone lines. Wes from Red Deer, Alberta, calling in with a question. Hi, Wes.
Yeah, hi, good morning. Thanks for taking my call. I'm calling this morning. My company is Corning, GLW. I was just wondering if you own this one and what your thoughts are on the company and where you think it may be heading. I've owned it for about 6 months. I'd like to keep it as a core holding. Thanks. I'll hang up and listen to your answer.
Thank you for that. Yeah, in the last 6 months, look at that.
So you've done well in the last 6 months. Like if that was the only parameters, I'd just say take profits. That would be my only. I used to own this. I think my cost base like $12 or something like that. And so, like,
it's a technology company, right?
So what they do is their core technology is glass making. So they started out making things like pipettes, remember back in science class, or pipettes or whatever they think.
Yeah.
Then they make Gorilla Glass, and they have glass that now goes on, smart glass that goes on car windows. And the big demand recently is the data center build outs and what that's going to do for demand. And everything's, so it's effectively, let's capture the effectively the data expansion from big data and capture it through fiber. And so I think there's going to be some truth to that. But when stocks gap like that and they gap up, it's the trend that's in vogue. Everyone wants it. Yeah. So in many cases, you're part of a Ponzi scheme. At what point do you have to get out? And so look, if you're in it and you've been in a couple of years, you've done fantastic. And then but I would still recommend trimming some profits. But I think that this is the kind of name where you buy where everyone hates it, and you hold it, and you can hold it for 10 years, and then you get that exact experience. So, for example, back to the reference point, when I previously owned it at 15. From 15, then if I had held it, would have been great. But it does go through periods of dead money.
Yeah.
So, quality company, no doubt. And watch for the joint ventures as well. But at these levels, I would not go there.
Okay, good to know. We're going to take another quick break right now. When we return, we'll take a look at some of Darren's past picks. That's coming up right after this. Stay with us. Welcome back to Market Call. We're going to go through some of Darren's past picks now. These are from March 4th, 2025, so just about a year ago. And we'll start with the first one, obviously, Canadian apartment REIT. So recommended at $41.25, now at $37.28. Are you still holding this one?
We only owned it about a month. So, and the whole reason, and it's been sold quite a long time ago, late last year, I think it was. And the whole premise was that the Ford government was going to address the complete disaster that's become the landlord-tenant board, and the whole regime around rent controls and various things like that. And that would have been very very positive for the company, but the Ford government did a taco and just completely reversed because they didn't want the bad PR, and obviously they want to stay in the government. So the renters basically forced the issue, and they decided they weren't going to do anything. So the disaster continues, but there's no point being in a segment when the underlying catalyst is not there. So we're out. It's a decent company, but there's no catalyst there.
So you wouldn't recommend getting into that sector really as a whole?
Well,
right now.
you know, until that segment's dealt with, until the regulators actually deal with that issue, it's just going to be continually to be problematic.
It seemed like there was a chart we were showing there where it seemed like there was a bit of a sharp drop off in April heading into May. So you sold it before that, you got out at a good time?
Yeah, exactly.
Okay, next pick is Franco-Nevada. So recommended at $206.79. Now it's at $373.70. So total return of 82%.
Yeah.
That's pretty good.
So, so taking the sort of the wisdom that I said in regards to risk management. So we did actually trim a little bit in January. You can see there's a little bit of a dip in January, just before the dip. So effectively around the top of the dip, the top of the peak, we trimmed some. But, we bought this company after the Cobre Panama shut the mines, and then the stop drop precipitously.
Yeah.
So we were significantly overweight in January. And then we trimmed it back. So, and then it's run further. So if this keeps running, we'll probably have to trim it again. But very, very good company, no debt. The royalty business is excellent. And obviously precious metals is benefiting enormously from the debasement discussions. So, we're buying it for clients. But obviously when we add for new clients, that's a name where we'd probably buy a half weight to start with.
Okay. Lastly, Microsoft. So recommended at $388.61. Now it's at $394. A company that seems to keep running. Obviously, total return of 2% since last March. Are you still holding this one? Have you trimmed it throughout the year?
So we haven't trimmed Microsoft, but if you look at it, it's actually given back quite a bit on the back of the AI. You can see.
Yeah. Wow.
So up when it was around 500 or so. We did actually have some fairly lengthy internal discussions around trimming it. We've owned it for a while. It's done really well. So at these levels, I think it's more attractively priced, and we would have no problem buying it for new clients. Whereas Franco is a bit more problematic. But I think longer term, as I mentioned, the 2000 era winners, Microsoft was one. You look at the long-term track record, it's done really well. Benefits from AI. It's got open AI exposure. Whether that's going to be a good thing, we'll find out.
And you're not worried about that aggressive spending we're seeing from some of these companies in their latest earnings reports? I
think what you're going to find with that is that boards at some point are going to say, okay, I'm spending all this money on AI in customers. What is that doing to my earnings per share? Is it actually benefiting me? So we're actually going to get to a point where, to sort of quote Jerry Maguire, the show me the money element on AI capex spend is going to come to the market, is going to come to the fore, and boards are going to rightly ask the question: are we seeing any benefit? And then the other questions is, what's the cost relating of actually taking 10% of your headcount out because you're going to replace it with an AI solution? What's the cost of that? So these are things that are going to move in real time. And at the moment, the market's very much hyped on AI and what that does.
Yeah.
And so for Microsoft, if it wants to sell off, I'm more than happy to buy it at these levels.
Okay.
Yeah.
We're going to take another quick break right now. We'll be back, though, with Darren Sissons of Campbell, Lee & Ross Investment Management, taking your questions on global and technology stocks right after this. Stay with us.
straight.
Hi there. Welcome back to Market Call. Darren Sissons is joining us on the show today, taking your questions. We're going to go straight to the phone lines now. Frida is calling in from Chilliwack, BC, with a question. Hi, Frida.
Hi there. Hi, Darren. I'm interested in Enbridge. I have quite a bit, mainly for the excellent dividend, and I'd like your opinion on it, as there has been quite a bit of growth as well. Thank you.
Okay, thanks so much.
Okay, Frida. So we own it. We sort of have it as effectively a relatively sustainable dividend income stream. I think that's what it is. Canadian energy in some shape or form is going to find its way to the US, and it's going to go through the pipelines. The big opportunity, obviously, in Canadian energy is the LNG terminal, shipping it out to Asia.
Yeah.
But I think longer term, I think that the animal that is LNG, the LNG terminal on the West Coast, is going to bring some level of let's call it parity in pricing for Canadians. Okay. So the discount might disappear. And I think those types of things are going to flow through beneficially to the pipeline sector for the Canadians. But I think it's a well-run company. It's got a good sustainable dividend. Management team seems to be doing all the right things. At the moment, it looks quite good because obviously it's had the gap up. But I think if you own this for a long period of time, the total, and you think about it in total return perspective, it's going to be a portion of your portfolio that's going to provide income to actually help you grow your portfolio from the cash proceeds. So we like it, and if you think it's a little expensive here, perhaps trim it and think about your weights. So if it's 10% of your portfolio, probably too much, cut it back.
Okay. We're going to go to an email now, this one coming in from David, and it reads, Adobe has been hammered over the last 6 months. Did I miss my exit point, or is there hope on the horizon? Thank you for that question. Adobe, you seem to like exit points at certain points. So, wow, look at that. I mean,
so I was looking quite closely at Adobe. And I think, the story here is that, I think this is AI hype overkill. And I think that, who does not have an Adobe reader on their computer now? Yeah. You need an Adobe reader. So what is going to fundamentally displace that? Having said that, look, the stock has fallen out of bed pretty significantly. And so, do you want to be catching a falling knife here? I think the names that have been beaten as a general rule, and I'm talking Salesforce, there's a lot of companies that fall into this category. Yeah. You've got to wait for a floor to settle if you want to enter, right? But the business is not going away, and I find it hard to believe that AI is going to completely disintermediate that whole category. So we wouldn't be buyers here, but if we found that some of the hype receded and we found that the company bottomed, but at the same time the company was continuing to grow, then we would take a look at it, because it is on sale, and it's on sale now, and significantly so. Yeah, I mean, looking at those charts for sure. So you wouldn't buy it right now, but you think it's got some maybe room to grow and it's like anything. I'm a buyer at X, I'm a seller at Y. Yeah. If a company is growing and it keeps repricing lower because the narrative is such that it's incorrectly capturing the story, then you should look much more closely at it. Yeah. Okay. Right? All right, another email now, this one from Millie, and it reads, do you think it's a good time to purchase Loblaw? Loblaw lagging today on the TSX. So thoughts on the company? Okay, so, when was the last time Loblaw's had the big run? So if you go back, let's see a long-term chart. So, the company's gapped up recently. Yeah. And, in essence, we're all paying more money for our groceries at a quantum level. But if you look like a 20-year chart, maybe even longer, then what you're going to see is it was dead money for a long period of time. So when a company like this, it's a consumer staple, has a massive gap up, if you're in it, you got to trim it. Mm-hmm. And so, look, I don't, I'm obviously a consumer of the company, but I don't think fundamentally this kind of growth is going to be sustained long period of time. So it's going to reach a new threshold, and then it will be largely dead money. It's probably not a good time to purchase, to answer Millie's question. No. Yes. Okay, we're going to move on to another email. This one coming in from Tom, and it says, what are your thoughts on Deere for a 3 to 5 year hold? So John Deere Company, thoughts on Deere and Co? Yeah, I think it's, tractors really support farmers, and I don't think that business is fundamentally going out of favor. Mm-hmm. But I think more loosely, if you're looking at, let's call it the broader infrastructure space, the logistics space, is it really something that I would do? I think, Caterpillar is probably slightly better opportunity if you're looking at just pure equipment.
Yeah.
Rails are probably better if you're looking at perhaps even more broader. So, look, it's a good company, but it just doesn't excite me. And I think there are just better opportunities elsewhere.
Mm-hmm. Okay, we're going to take another quick break right now, but we will be back with Darren Sissons of Campbell, Lee & Ross Investment Management, taking your questions on global and technology stocks right after this. Stay with us. Hi there, welcome back to Market Call. We'll go straight to the phone lines. We've got a caller calling in from Stanhope PEI. Fred is calling. Hi, Fred. What's your question?
Hi. Thank you both for taking my call. My question regards Diageo. I've been a long-time holder of it, probably too long, and then kind of let it ride for the most part until recently when I started reading good reports from just about every analyst on the face of this planet, including brokerage firms who said you should buy more. So I bought a little more and then woke up this morning to some terrible news, an 80% cut to the dividend and a 10 or 11% drop to the price of the stock. I'm curious, Darren, what you think about it and any comments. I'll hang up and look forward to what you have to say. Thank you.
Okay, thanks, Fred. Yeah, not great news for Diageo today. Thoughts on where they're sitting?
Yeah, can we just see like a longer-term time frame? So I think the story with Diageo, and I did own it in a previous life, and it was very good. And it used to be a growth by acquisition story, but they really have acquired most of the high-quality franchises. And to me, the turning point for the company was when they missed the Beckman family Jose Cuervo tequila brand. They couldn't bring it in-house. And at that point, once that happened, it became effectively a cost-saving story. And because the only real major assets left are, if I remember correctly, is the Jim Beam assets. They could perhaps do a hostile and take over Brown-Forman, but
there's not much room there.
There's not a whole lot of room to grow it significantly. So, I'm really not surprised that it's had the performance. But if you compare it, you look at it, say Brown-Forman's been a disaster as well. So, one of the challenges is young people aren't drinking. There's probably other issues as well. But I think that at this point, if you're looking for a safe defensive story on the consumer side, there are probably better places to look right now, like Nestle. You could look at Procter & Gamble, the same type of underlying safety with a dividend growth component. Unilever, also all good. So for me, I'm not surprised that they've done that, but I think it's just time to perhaps sell, I think, here.
And cutting the dividend, as Fred mentioned, like now it's at 3.7%. Is dividend important to you when you're looking at a company, or?
So there's a few things that happen when companies cut dividends. So if they cut the dividend and they want to do it to perhaps lower debt so they can facilitate an acquisition, then that's a positive story. If they want to perhaps encourage shareholders to take a scrip dividend, and a company I'm looking at the moment quite closely, 80% uptake. And so effectively the net proceeds to end clients meant that they could then use the cash to pay down debt. So you've got to look at the underlying reasons why the dividend's been cut. But as a general, optically it looks really poor.
Yeah. Okay. Yeah. We're going to move on to another caller, Peter calling in from Vancouver with a question. Hi, Peter.
Hi. Good morning, Mr. Darren Sissons. You are from New Zealand, land of the Maori.
Yeah.
I studied in Australia, famous for its kangaroo. So today I'm going to ask you about a good oil stock in Australia called Santos. Thank you very much, Mr. Sissons.
Okay, thanks for that.
Yeah, so Santos, good to hear from you, Peter. So Santos obviously is I wouldn't call it a super major.
Okay.
But it is benefiting, obviously, from the Australian energy reserves. And what was interesting, I saw a headline this week, and I have yet to fully unpack it, but the narrative was that Australian gas is being sent to Europe. I think it was to Turkey, actually. And the reason why is the demand from Asia is softening. And so there is long-term contracts with regards to, obviously, the natural gas that's being exported out of Western Australia, out of stumbling for a blank on the state at the moment, but effectively the challenge is that is in demand softening. But I think if you look at it from a fundamental point of view, there is a good opportunity for the company, and I think the energy prices look quite cheap. Natural gas, I think, is going to be the feedstock moving forward. It appeases to some degree the green movement, but it's also portability and things like that. So Australia's got a lot of reserves, and I think that's interesting. The company looks interesting. It's probably a bit small for us. We would own a Shell as opposed to a Santos. And in terms of Australia, obviously the best asset I think is BHP there myself on the commodity side. So it's a good company, but we would prefer something a bit bigger, Exxon or a Royal Dutch Shell or something like that.
Okay. Another caller now, Larry, calling in from Toronto with a question. Hi, Larry.
Hi, folks. Thanks for taking my call. Appreciate it. I'm just trying to get a handle on your feelings about AI and the vertical integrated companies like Constellation and Top, because I own a little bit of Constellation from a long time ago, and I'm just curious as to your thoughts on how you feel AI is affecting their stock. As you know, it's gone down 50% almost, and seems like it's coming back, but it seems like nobody can give a real good answer of what the long-term effects will be on their vertically integrated software. Just wondering if I can get your thoughts and if you own Constellation as well.
Okay, so if you've owned it a few years and it's corrected 50% this year, you're still in the money. So congratulations there. And those people who've watched me for a longer period of time on the show, on this show, have seen that I'm not really a huge fan of Constellation. And the primary reason is it's just a what I would call a hodgepodge of companies just keep integrating with no real verticalization. And so the example that I've often referenced locally is OpenText. So they've got deep verticalizations, and they largely do tuck-in acquisitions as well. One has a very attractive valuation, and one had an extreme valuation.
Right.
So the fact that the Constellation software story is melting to some degree, in many ways, is just a valuation reality check. I think that's one thing. The question of a lot of the offerings that occur for Constellation software are very small, smaller opportunities. So the question becomes: is it economically worthwhile to displace a story, a software offering with an AI solution, and then go to market and displace the company?
Okay.
Well, I think that yet remains to be seen. So AI is going to be a problem for larger opportunities, but probably not for smaller opportunities. So in this case, we wouldn't buy Constellation purely on valuation parameters.
Got it. Okay, thanks for that. We're going to take another quick break right now. When we return, though, we'll take a look at some of Darren's top picks. So that's next. Stay with us. Join us tomorrow on Market Call, and Mike Philbrick will be on the show. He's CEO of Resolve Asset Management, and he'll be taking your questions on ETFs. And if you missed Market Call, you can check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. Okay, and Darren Sissons, of course, here today in studio. It's time now for Darren's top picks. So we'll go through these one by one, obviously. Atlas Copco is your first top pick, Darren, and this is what you say it's a global leader in vacuum technology.
Yeah, so global leader in vacuum technology. They run an asset-light business model, which means that they focus on the core product development, outsource manufacturing, and that type of thing. From a Canadian perspective, 10-year, 5-year dividend increases on an annualized basis at 10%, or 6% on a per annum on a 10-year basis. So that's quite solid. And has fairly high return metrics because of the asset-light nature. And then last year, because it obviously has exposure to the semiconductor market, it was quite weak. So given the forward prospects, the tuck-in acquisition process that they utilize, I think it's a very good value. We've owned it for quite a few years, and it's we're sitting on a multiple of cost base. So I think it's going to be good. It's going to benefit from AI spend, I suppose. So, yeah.
And it's a European company. Like, we didn't really talk about this, but obviously you deal with global stocks. But is this a good time for people to maybe have never invested internationally to start looking at that in 2026?
Well, I think, I would answer that this way. If the USMCA agreement gets ripped up, Canada's not going to be a great place to invest.
Right.
Right. So you want to have at least some diversification. And, we don't have a vacuum technology company here in Canada of the global scale. We don't have pharmaceutical companies here of scale. So if you want, in diversification, then you need to look internationally anyway.
Got it. Okay. Next one is automatic data processing. What do you like about this company?
So ADP, it has very significant regulatory payment moats, even structural moats. So the company sold off on the back of ADI, but yes, quite easy to build a payroll processing platform, but you have to get connectivity to banks, regulators, through to the IRS, CRA, and then you also have to process, for example, spousal, parental garnishments, or if you have garnishments for debts and things like that. So it's a very good company. Typically, when it's at these levels from a dividend yield point of view, it goes on sale. And ultimately, 51 years of consecutive dividend increases. So,
wow.
Yeah, 140 companies, they process 1 in 6 employees in the US. So it's on sale.
Interesting. On sale right now. Okay. Last pick is CN Rail. Obviously, this company has had a rough road over the last year or so, particularly with the tariffs that are in place. Do you foresee that changing, or what do you think about
I think
CN?
if you look at what happened fundamentally, and then you see the chart just recently, and you figure out what happened. So the market sold this company on the back of tariffs are going to be bad. But remember, something like 95% of all the goods shipped to the US at the moment are currently tariff exempt under the USMCA. That was the first point. And then the second thing is just the pure integrated nature of North American logistics. If you're in one part of the US, your choices are a truck or rail for transport. Depending on where you are, you're either a truck or a Canadian rail, CN Rail. So that's not going to change. Revenues are up a couple of percent. They raised the dividend for 2026, and they bought back $2 billion worth of stock last year. And they announced a new stock buyback. So look, if the stock goes down, they're going to buy back more.
So even with these, because the renegotiations in the summer could affect a stock like this as well, right?
Oh, for sure.
Yeah.
And, remember how they fund the buyback is they've owned the underlying real estate for what, 200 years? And they sell off a piece of real estate to fund the buyback. $5-10 million one-time special dividend that seems to happen every quarter. And that's what funds the buyback. So good operating business with an attractive dividend increase buyback story. And when these types of companies are on sale, then the buyback has much more power. It's much more accretive. So for longer-term investors, this is a good story.
Interesting. Okay, that's all the time we have, but appreciate you coming in studio. So good to have you today. Thanks so much.
Good to see you.
Thank you for watching Market Call. That's all the time we have. We'll see you next time. Roger Peterson is up next with Trading Day. Stay with us.